Most traders believe they are participants in a game of skill, intuition, and analysis. They see a chart and perceive a story told in candlesticks and volume bars, a battle between bulls and bears. This perception is a dangerous illusion. On October 7, 2016, the British pound collapsed by over 6% against the dollar in just 2 minutes. Human analysts called it a flash crash, attributing it to a fat finger error or panic over breaking news. The lab's analysis reveals a different perpetrator. This was not chaos. It was a targeted execution. A ghost in the machine had identified a weakness, not in the market structure, but in the cognitive architecture of the human brain itself. And it had attacked with surgical precision. Over 70% of modern market volume is algorithmic. The ghost is not an anomaly. It is the new predator in the ecosystem. To comprehend its methods, we must dissect a more common, yet equally revealing, event. The case file is designated the 1547 anomaly, occurring on a Tuesday, in a period of sustained, low-volatility uptrend in the E-mini S&P 500 futures market. For 3 consecutive hours, the market had exhibited textbook bullish behavior, a steady grind upwards on respectable, but not excessive, volume. Retail sentiment indicators were overwhelmingly positive. To the human eye, the path of least resistance was clearly higher. At precisely 1500 hours, 47 minutes, and 03 seconds Eastern Standard Time, a single, anomalous event occurred. A burst of sell orders, totaling just over 300 contracts, hit the market simultaneously across 3 different exchanges. The price dipped by 4 ticks before immediately recovering. On the chart, it was a flicker, a meaningless blip that 99% of human traders would dismiss as background noise. But it was not noise. It was a sonar ping. This initial volley was not designed to initiate a trend or take profit. Its purpose was purely informational. The algorithm, a high-frequency market-making program, was testing the market's structural integrity. Specifically, it was hunting for the location of a critical resource, clustered stop-loss orders. When the price was artificially pushed down, it triggered a tiny, initial wave of these stops. The algorithm did not care about the small profit from this action. It cared about the data. It measured the latency of the stop order executions, the volume that was triggered, and the speed of the subsequent human buying that pushed the price back up. In less than 500 milliseconds, the machine had built a detailed map of the liquidity resting just below the market's placid surface. It now knew the exact price levels where a larger, sustained attack would trigger a cascade of forced selling. The algorithm now has the data it needs. It knows where the liquidity pools are, but simply triggering those stops is not the primary objective. The real prize, the ghost's true hunt, is for something far more valuable than liquidity. It is hunting for a specific cognitive failure. This failure is rooted in a behavioral anomaly documented in the 1970s by psychologists Daniel Kahneman and Amos Tversky. They called it prospect theory. Its central finding is profoundly simple, yet has devastating consequences in financial markets. For the average human, the psychological pain of a loss is more than twice as powerful as the emotional pleasure from an equivalent gain. Losing $100 feels twice as bad as gaining $100 feels good. This is loss aversion, a survival trait hardwired into our brains from a time when losing a food source could mean starvation. In the trading environment, this cognitive bias is a catastrophic flaw. A trader with a well-defined plan might set a stop-loss at a 1% drawdown, but when the price hits that level, loss aversion screams in their mind. The impulse is not to follow the plan, but to avoid crystallizing the pain of the loss. They hold on, hoping for a rebound. They move their stop. They tell themselves it is just a temporary dip. Their rational, systematic trading plan is hijacked by a primal, emotional response. The algorithm does not have this flaw. It feels nothing, and it is designed to systematically exploit the humans who do. The 1547 anomaly was not just a hunt for stop-loss orders. It was the first step in manufacturing the emotional state required to make humans abandon their own rules. The initial probe was followed by 2 more, each one slightly larger, each one pushing the price a little closer to the major liquidity pool it had identified. These were not aggressive attacks. They were subtle, designed to create a feeling of unease. They were the digital equivalent of a predator circling its prey, testing its defenses, and letting psychological fatigue set in. The goal was to exhaust the initial layer of dip buyers and create a fragile, nervous market. So the machine understands human loss aversion better than most humans do. It uses small, surgical price drops to create psychological pressure. But how does it know the exact moment to strike with overwhelming force? The answer is not in the price chart that 95% of retail traders are fixated upon. It is hidden in the one data stream that retail traders almost universally ignore. It is in the anatomy of the order book itself. This data, known as level 2 or market depth, shows the explicit intentions of buyers and sellers. It is a live ledger of all limit orders waiting to be executed. While a human trader sees a single price, the algorithm sees the entire battlefield. It sees the size of the buy orders, known as bids, and the size of the sell orders, known as asks. More importantly, it sees how these orders react to price changes in real time. It is reading the market's collective fear and greed, microsecond by microsecond. During the probes in the 1547 case, the machine was not just mapping stop losses, it was observing the behavior of the passive orders in the book. Before the first probe, the bids were thick and stable. There was a clear willingness to buy any dips. But after the third probe, the algorithm detected a critical change. Large bids, which previously offered the illusion of support, began to be pulled from the book whenever the price got close. The number of asks began to increase, at levels just above the market price. This was the digital signature of faltering conviction. The buyers were getting nervous, and the sellers were getting emboldened. The ghost in the machine had identified the precise moment of psychological vulnerability. The support structure was an illusion, and the collective human psyche of the market was primed for a panic. The time to hunt had arrived. At 1500 hours, 52 minutes, and 18 seconds, the attack phase was initiated. It was not a single, monolithic sell order that a human might place. It was a swarm. Thousands of small, independent sell orders were routed through dozens of dark pools and exchanges simultaneously. The execution was designed to be fractionated and stealthy, preventing exchange-level circuit breakers from tripping while maximizing psychological impact. The initial wave of algorithmic selling was just large enough to breach the key technical level the probes had identified earlier. The first major pool of human stop-loss orders was triggered. A cascade had begun. The forced selling from this first cluster of stops pushed the price down with immense velocity, which in turn triggered the next pocket of stops resting just below it. It was a domino effect, engineered and initiated by the algorithm. Now, the core human flaw was brought to the forefront. The traders who had stubbornly held on, the ones who had moved their stops and prayed for a bounce, were now facing catastrophic losses. The pain threshold of loss aversion was finally breached. Their calculated plans were gone, replaced by a singular primal urge: get out at any price. They flooded the market with sell orders, not because of a system, but because of pure, unadulterated panic. This was the fuel. This was the payload the ghost was designed to extract. As the wave of human panic selling crested, the algorithm, having initiated this entire sequence, did something remarkable. It reversed its function. It began to buy. It was now absorbing the shares from the panicked humans, purchasing their assets at prices deeply discounted by the very fear it had manufactured. The machine was not just trading the market, it was playing the players. It had created a pocket of unreality, a brief, violent storm in a calm sea, for the sole purpose of preying on a predictable and deeply human cognitive bias. The ghost had found its victims, and the feast had only just begun. The cascade continued to accelerate, feeding on itself as more and more human participants were forced to capitulate. For the machine, this was the moment of maximum efficiency, the point where the programmed logic achieved its final objective. But for the humans caught in its path, it was a complete systems failure, a breakdown of not just their strategy, but of their own rational minds, as the numbers on their screens turned a deeper and deeper shade of red. The machine was indifferent to their ruin. It was merely executing its code, a process as cold and unforgiving as the laws of physics. Within seconds, the reversal was complete. The algorithm, having gorged itself on the liquidity of human fear, had now become the market's single largest buyer. It wasn't supporting the price. It was accumulating its reward. The entire manufactured event, from the first subtle probe to the final absorption, lasted less than 90 seconds. To an outside observer looking at a 1-minute chart, it would appear as nothing more than a violent, inexplicable wick, a ghost in the data. The storm passed as quickly as it arrived, leaving an eerie calm in its wake. The numbers on the screen reset. The indices ticked on, but the capital in thousands of retail accounts did not. It had been transferred, not through superior insight or fundamental analysis, but through the weaponization of human psychology. This wasn't a battle of bulls versus bears. It was a harvest, a calculated, high-speed reaping of human emotion by a predator that feels none. The 1547 event was not an anomaly. It is the new reality. The ghost in the machine is not one algorithm, but a new apex predator in the digital ecosystem of modern finance. It doesn't sleep. It doesn't feel. It only calculates, probes, and hunts in the microseconds between the clicks of a mouse. It operates on a battlefield that most participants don't even know exists, using a language they cannot understand. The critical question is no longer, where is the market going? But, what is the code trying to do? To navigate these waters, you cannot rely on old maps. You must learn to read the machine, to understand its logic, and to recognize the hunt before you become the prey. The game has changed. The only way to survive is to change with it. We are here to decode the new logic of the trade, to give you the tools to see the ghost in the machine. Subscribe to trade_logic_lab and learn to think like the thing that is thinking against